If you click this video, you must be looking for ways to make more money every month, and that is a good thing because most millionaires have multiple streams of income.
That's right, Max. Investing in ETFs that pay monthly dividends is a terrific way to create a passive income stream. All you need to do is buy, hold, and then collect your monthly dividends.
Initially, you're going to want to continue to reinvest your dividends until they can cover some of your monthly expenses or until retirement. One of the best things about monthly dividends instead of quarterly is that you can reinvest more often, which helps your money compound quicker.
In this video, we're going to go over 6 dividend-paying ETFs that have been paying monthly dividends for years upon years. These ETFs aren't the highest paying dividend funds out there, but we chose them because they should provide a reliable stream of monthly income.
Now that you have an idea of what type of dividend ETFs we look for, let's jump right into our list, starting with the Global X Super Dividend U.S. ETF, ticker DIV. This ETF has been making monthly distributions for 8 years running.
The fund holds 50 of the highest dividend-paying companies in the US and screens all of its holdings to make sure they hold low betas relative to the S&P 500. Essentially, they seek stocks with low volatility while still consistently paying out dividends.
The sector weightings of the fund are heavy in financials, utilities, and consumer staples, which are known to be safer investments. Generally, companies that people do business with as part of their daily lives are often very defensive when the markets are shaky.
Shaky?
Shaky.
Looking at the numbers, DIV has a current dividend yield of a little over 5% and an expense ratio of 0.45%. Also, while other funds are seeing losses year to date, DIV is basically trading sideways.
While there are higher dividend yielding ETFs out there, we like DIV for providing solid dividends while being able to resist capital erosion during down markets.
Moving on to the second pick on our list, we have the Invesco High Yield Equities Dividend Achievers ETF, ticker PEY. This fund consists of 50 of the top companies from the NASDAQ index with a focus on dividend distribution growth.
PEY is considered to be a mid-cap value fund, which means the companies they hold will have a market cap between 2 and 10 billion. The idea behind this ETF is continuous growth without the volatility that small cap companies usually experience.
Similar to other dividend-focused ETFs, PEY has heavy sector weightings in financials, utilities, and consumer defense. Some of the largest holdings within this fund include Altria Group, AT&T, and IBM.
PEY has been consistently paying those sweet monthly dividends since 2006. Now that is a long history you can rely on if you're looking for monthly income. The fund has a current yield of 3.8% and an expense ratio that's a little higher than average at 0.53%.
PEY is up 2.5% year to date, which is currently better than the S&P 500. That is down around 6%. It also has an over 10% total return over the past 12 months, which is respectable for a value-focused ETF, and that's why we think it's worth taking a look at.
Next up, our third ETF is the WisdomTree U.S. High Dividend Fund, ticker DHS, which is considered a U.S. large cap value fund. This means they primarily hold some of the biggest companies in the U.S. that emphasize dividend income.
The sector breakdown is slightly different from our first two funds, with more of a focus on healthcare and energy. Some of the companies within this ETF that you might be familiar with are ExxonMobil, Chevron, and Pfizer.
With the price of oil skyrocketing, the fund has the highest year-to-date return on our list of just over 5%. DHS has been paying dividends since its inception in 2006, and in 2012, it changed its distribution from quarterly to monthly and still remains consistent today.
DHS has a current dividend yield of 3.15% and an expense ratio of 0.38%. Its share price is near its all-time high though, which is good if you've been holding this ETF, but not really if you're looking to buy in.
Unless you're like me, who likes to buy at the top.
He does.
Nonetheless, DHS is definitely worth keeping on your list if you're looking for monthly income.
Before we go on to our next ETF, we gotta take a minute and pause this video because we want you to like the video and subscribe if you haven't already.
And now that we have that out of the way, coming at number 4 is the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD, which is well known to be one of the most stable monthly dividend ETFs available.
SPHD is similar to DIV as it focuses on 50 of the highest dividend and low volatility companies from the S&P 500. Aside from a slight fall in 2020, it's traded sideways for at least 5 years.
The stability of this ETF comes from holding companies like Iron Mountain and Kinder Morgan, which have helped SPHD pay monthly dividends since its inception in 2012.
SPHD has a dividend yield of 3.4% and the lowest expense ratio on our list at 0.3%. Year to date, it has a return of 1.78%, which isn't bad considering the current state of the markets.
There's definitely some overlap in the holdings with some of the other ETFs on our list, which include companies like Altria Group, Kinder Morgan, and Chevron. Be aware of the holdings within your ETFs as they could create too much concentration in a few companies.
Some of the top sectors within this ETF are utilities, consumer staples, real estate, and healthcare, which are historically good hedges against bear markets. Utilize this ETF to weather volatility and to get those sweet dividends.
The last two funds on our list are a little bit different than the rest, as they hold companies that offer preferred shares rather than common stocks. Preferred stocks are generally safer as they have priority on dividend payouts over common stock holders.
They may also receive higher dividend than common stocks, but often aren't granted voting rights. Either way, preferred ETFs are perfect for retirees or people looking for monthly income.
This brings us to our fifth ETF, which is the iShares Preferred and Income Securities ETF, ticker PFF. This fund has exposure to U.S. companies that offer preferred stocks to investors looking for dependable monthly dividends.
PFF has financial sector weightings of over 60% with big names like Wells Fargo, Bank of America, and Citigroup. Despite these stable stocks though, PFF has seen a bit of a dip with a year-to-date loss of about 7.6%.
It is still churning out monthly dividends with a current yield of 4.6%, and the expense ratio is 0.46%, which isn't the cheapest on our list, so keep this in mind if you're deciding to pick this one up.
Finally, our last ETF is quite similar to PFF, the Invesco Preferred ETF, ticker PGX, which also focuses about 80% of its holdings around preferred U.S. securities.
The fund has a high sector weighting in financials and utilities, but one difference between them is that PGX holds considerably fewer industrial holdings than PFF. However, the top holdings between the two do overlap quite a bit with companies like JP Morgan and Bank of America.
PGX has a current dividend yield of 6.05% and an expense ratio of 0.5%. Year to date, it's seen a similar dip to PFF as it's down a little over 8%. This isn't great news if you're already holding PGX, but it's awesome if you're looking to get in.
PGX has been a consistent monthly income producer since 2008. It also has almost 300 holdings and none are over 2% of the portfolio. With a share price of just over $13 and a yield over 6%, this low-cost ETF could be ideal for new investors.
That is our 6 monthly dividend-paying ETFs that can help you build another stream of income. As always though, do your own research on anything that we say, and especially these ETFs.
We're not financial advisors, and this is definitely not financial advice. We're just two high school buddies talking about building wealth.
With that said, he's Max, I'm Mike, and we're high school buddies.
And we'll see you next week,
Buddies.
Now that you have an... What the...
Now that you have...
The markets are shaky.
Did you say shaky? It's cold up there. Moving on.
Starting with the Global X Super Dividend U.S. ETF, ticker DIV.
Super!
Mozzarella!
Mozzarella! Capicolo.